All right, so today is Wednesday, April 9th, 12:30 section. The sec class is being recorded. Want to do a few things today, but one, just remind you about some upcoming logistics. So your next homework assignment is due on Monday. We will be talking about some things that we're going to make changes to the model that are necessary to that assignment on Monday. So you have to do that first before you do your next assignment. And a week from today, you will be doing your team presentations. So I posted an announcement, already got started to get some emails. Some people want to give me their choices before we leave class today. Happy to put those in. Basically, I've assigned each of the sections an industry. So for example, you're the 1230 section and your industry is, say, fast casual. So McDonald's, Chipotle, somebody took Domino's Pizza already, but you can just look at the BICS fast casual for any of those firms, and you need to choose one. It's first come, first serve. So basically, next Wednesday, you'll be doing a 10-minute verbal presentation. So everything that was in the write-up is going to be in the PowerPoint. You'll turn in 4 Excel files, your as is, your bull, your bear, your target, and then you'll walk through the valuations in the Excel. And very important, you have to put the screenshots from the Excel into the PowerPoint. Anything that is not in the PowerPoint will not be graded, even if you turn it in separately as an Excel file. That is basically one of the requirements for the presentation. But again, you got to cover the as is, the bull, the bear, and the target in that 10-minute presentation. What changed and why, giving the business context for why you did it, as well as the numbers that you had changed. And so that is going to be a week from today during your regularly scheduled class in person in Van Munching Hall. So questions about the group projects? All right, so let's talk about the as is valuation that you did for Target, which basically would have changed based on the day of the week last week you did it. Because as you can see, Bloomberg, share my screen. TGT. Today the share price has fallen to 88.91, and when I did the as is over the weekend, it was in the 90s. You can see that even over the last month, their share price, like the share prices of many others, have collapsed. So they went from 105 to about 89. So depending on when you did the valuation in this period, you could have slightly different numbers. That's again another reason why it is so important to turn in your screenshots, because you're doing a time point valuation based on the data at that time. And this is more of an extreme example, but nonetheless, share prices can move, data can change relatively quickly, as you're seeing in the real world. So anyways, the other thing, actually, before I do, let's just make sure we check in quickly on the trading challenge before we get into Target, because I'm sure it looks ugly. T. All right, so trading challenge, second half. We'll go by section. Here's 101. One team actually figured out how to make money so far. Everybody else in the red, not surprising. Well, it's not that red considering how bad the markets have been. In section 101, 201, which is your section. I got 2 teams that slightly positive, 4 teams that have lost money so far. Everybody's still under the minimum cash. That is good. Section 301, put it up here. And section 401. Oh, all right. K-Chen, warning, first and only. You have until the end of today to get below $300,000 worth of cash, or your team will be disqualified. So, K-Chen, you know the rules. Please follow them. One and only warning. All right. Any questions about the trading challenge? Remember, you can buy ETFs that go in the other direction of the market if you don't want to sell short. If you think the market's going to continue to fall, but a lot of volatility, a lot of opportunity from a volatility standpoint in the marketplace. All right, let's go back to Target. So in the as-is valuation that I had done, the price of Target at the time, which I'll put here in my assumptions, was 95.72. Okay. And so to make the 95.72 share price worked, kind of following our process, updated the last reported year, 2025. Time, their WACC was 7.5% last week. Share count 455.6. These were the consensus revenue and EBITDA for the next 5 years. And then over here on the ratios for the as it, this was the tax rate guidance that they had given under GUID, 23.5%. Left the EBITDA margin pretty close, 8.5 versus 8.6. Again, 3% growth, solve for a G, and the G at the time was negative 1% that had gotten the share prices to match. And again, the question about G comes up from time to time. Can you have a negative G? Absolutely. Now, there's 2 points to G. Number one, we know mathematically that the formula for a perpetuity is cash flow divided by R minus G. G can never be greater than your R. That would be a fundamental math error, which would make your model invalid. Right? Now, target's 13%, so long way to go there. But regardless, you can never have a G greater than your R. That being said, can G be negative? It can be negative, right? 2 situations. One, company's going out of business, right? Or 2, negative 1% basically means the market thinks the future is worse than the present. And think about just revenue and profits going down 1% every year into perpetuity, right? It says that target has peaked, the future is kind of grim. Now, if this were 10% every year, that'd be a different story. Negative 10% G, take revenue, knock 10% off every single year. Target's basically going away. So you got to be careful when you get some big negative G's that don't make any sense in your marketplace. So it's just kind of a warning as you think about G. But as we talked about, getting the G right is very important in our models, right? So again, high level, most of the valuation that we are doing is based on key value drivers, okay? It's this formula right here that's driving the continuing value, right? And so, as I mentioned before, it's the growth and the ROIC. Those are the 2 most important parts of the valuation. Got to get the growth right, got to get the ROIC right. We kind of know the WACC, right? And our process has been understand the ROIC to get to the G. Now, understanding the ROIC means we got to understand the drivers of ROIC, which includes our EBITDA margin. Okay, so we got to get that right. And what we've been doing is we've been kind of eyeballing. So this is the modification that we're going to make. I'm going to do that to the target model, kind of revalue them today based on that. Okay. So right now, target share price, make an adjustment. At the time of this class is $89.16. I'll do my screenshot here. file. Target DES, actually. DES, let me go to the DES first, take the screenshot. Doing our as is. This in the download folder. So that was 89. Let's see what that screenshot says. Oh God, screen gets squeezed like this. It was 89. I'm gonna say it's 8909. 8902. We'll use 8902. Close enough. So Excel. All right. So I'm redoing my as is. So I'm going to save this file. And this is the one we're going to use going forward, which is April 9th. And I am going to value down to 8902. Okay. All right. So let's see if anything has changed in the EEO or the WAC since then. So WAC as of April 2nd is now 7.8. So this is my WAC. As of April 9th. 7.8% versus 7.5. Share price we've updated there. See if the EEO has changed. On an annual basis, 107,510. That's also changed. All right. So let's put this here. And let's put this here. Split the screen. All right, so this is gone down 107,510. Again, reason why we do screenshots. 109,976. One 113,238 didn't change. 116,069 and looks like they didn't change the out years, just the first couple of years in their models. In terms of the analyst consensus. And then 2030 is 119,492. All right, that didn't change. 30 didn't change for EBITDA. 99.73 didn't change. 93.63 didn't change. Let's see if this changed. 2028 EBITDA 93.63. 2027 89.79. I went down a little bit. And for the current year, $86.31 change, but went down slightly. Okay, nothing too dramatic, but there were some changes in the EEO. Okay. Did anything change about tax rate guidance? GUID. Kind of redoing the as is. And the tax rate guidance is still 23.5% as of today. So that's the number there. All right. So the key is, and I'm going to go back to trying to make this full screen again. Oh, I thought I showed the split screen. Maybe I didn't. What I was doing is I was just looking at Bloomberg's EEO and updating the numbers on the assumptions tab. All right, so now that I've done that, I need to make sure that this EBITDA is right, because that's an important number, right? Especially in 2026. I don't know why it says 0. What happened there? Oh, must have deleted that by mistake. All right, 8%. Okay, but the perpetuity EBITDA is the most important one, which is 8.6, right? So how do I know that 8.6 is right or close to being right? So this is the modification that we're going to make, and it comes from the next section of the class, right? And it comes from our EEO screen. So what we're going to find out in multiples is multiples are very much related. They're just the key value driver formula shortened. So instead of going 5 years to continuing value, you just do a continuing value immediately. It's kind of what a multiple is. And they're really an expression of growth and spread. So that's all multiples are. They're a representation of future expected growth and spread. So when you rearrange the math, which we're about to do, if you take the enterprise value to revenue multiple, and you divide it by the enterprise value to EBIT multiple.
Hi, excuse me, we can't see your screen. It's on the camera.
Oh, sorry. Zoom. Thanks for letting me know. Here we go. So on the assumptions tab, starting in row 16, if you take your enterprise value to revenue multiple and you divide by your enterprise value to EBIT multiple, that will get you your EBIT margin in perpetuity. This is the modification we're about to make. For now, trust me, the math works. But when you read the book and we go through the next section of the class, I'll show you the derivations of all these formulas. But the point here is that when we do multiples, forward multiples are more predictive than historical multiples because we're trying to predict future cash flows, not historical cash flows. More importantly, forward year 2, forward year 3 multiples are more predictive than forward year 1, right? So what am I talking about? I'm going to just share my desktop again because this is too hard to go back and forth. So let me get this out of the way. All right, so if we go back to Bloomberg, which hopefully you'll be able to see. Again, I'd split my screen, so I'll make it full screen again. EEO. Convention. Forward year 1, forward year 2, forward year 3, forward year 4. Actual. You can see right there. You start counting the columns, right? This column is less desirable for future multiples. And the reason why, Joe's words, I like to say that 2026 for Target is a dirty year. And what I mean is we're in April, all right? So we already have 3 months of actual data and we got 9 months of forecast data, right? 2027, forward year 2, is the first year of 12 clean months worth of forecasting. So when you do multiples, it's ideal to have a pure forecast year as opposed to a mix year where you mix actual and forecasted data. And the worst is when you do historical data. Okay, so bad, less bad, better. So these 2 years, or even sometimes these 3 years, are much more predictive of the long-term value of a publicly traded company than these years. So down here, same thing. Let's say we're doing the price to earnings multiple of target, right? This is forward year 1, this is forward year 2, this is forward year 3. These 2 years are more important than that year from a valuation standpoint. Okay, so we're going to care about forward year 2 and forward year 3. Now, back to our model. What do we need? We need EV to revenue in forward years 2 and 3, 0.51 and 0.49 respectively. So back to Excel. That's these, which I'll make yellow. 0.51, 0.49 are the EV to revenue multiples for target for 2027 and 2028, forward year 2, forward year 3, based on today's share price. Translation: for every dollar of revenue generated by target, they generate 51 cents of market value in 2027. For every dollar of revenue in 2028, they generate 49 cents of market value. That's what, or enterprise value, essentially. That's what that multiple says. Same period, EV to EBIT multiple, forward year 2 and forward year 3. We go back to Bloomberg. EV, it's right here. Forward year 2, 9.28, 8.91. 9.28, 8.9. And again, if you're wondering like where these forward multiples calculated from, it's pretty straightforward. Give you an example of PE. 89.15 divided by 2027 earnings per share of 9.66 is a multiple of 9.23. 89.15 divided by 10.343 is 8.62 for a PE, right? So it's the current price or the current enterprise value divided by whatever metric you're looking off the income statement: revenue, EBITDA, EBIT, etc. Okay, so Bloomberg just does that for you automatically. But the point is, these forward year 2 multiples are the ones we care about. Okay, so you should have in your model something that looks like this. We're going to do this for every company going forward that's publicly traded. Because if you take the EV to revenue and you divide by the EV to EBIT, the perpetuity margin, the EBIT margin and perpetuity that works to generate those multiples is 5.5%. Now, sometimes because the second and third year could diverge a little bit, you might get a range. It might be like 5.5% in 27 and 5.8% in 28. They're kind of giving you a range of where their EBIT margins could be. But for target, I'm telling you, you go to anybody on Wall Street and you look at their DCFs, they're going to be having an EBIT margin, a perpetuity margin, somewhere around 5.5%. Because that's the only way these trading multiples work at the current valuation of the company. That's just math. Questions? So what is this number? This 5.5% is the operating income. We're using EBIT and operating income essentially interchangeably. So we know that in perpetuity, based on the current share price, row 6, which is operating income, the perpetuity period is 2031. That cell should be 5.5%, not 5.7. So based on the trading multiples today and the share price today, the market is estimating that their long-term operating margin will fall to approximately 5.5%. Now you'll notice in our model, that cell is not yellow, right? And if you look at the formula of that cell, it's EBITDA minus the DA equals the EBIT margin or the operating income. So the way we're going to make this 5.5% is not directly change that, which could break the model. What we're going to do is we're going to lower the EBITDA. Right? Because depreciation tends to stay pretty stable over time. It's the EBITDA that's going to fall. And so in a sense, what EBITDA gets me to an EBIT of 5.5, it's going to be not 8.5, but 8.3. That is what the trading multiples are saying of Target today. That essentially they're predicting that the EBITDA margin, which they thought was going to be around 8.6, is going to fall to 8.3 in perpetuity. That's what justifies a lower share price. Questions about what I just did? So after you've completed your process, and this is now the second to last step in your process, you will estimate the EBIT margin by looking at the forward multiples of every company, including the one you're going to do next week, for both your group project as well as homework 10 or 11, whatever the next assignment is. And you're going to adjust it not by directly adjusting this, but by adjusting the EBITDA to get this to match this number. As I said, if it's a range, let's say it was 5.5 to 5.8, you adjust the EBITDA to be somewhere so that the EBIT is in that range. And then you have to make a discretionary choice. Do you think it's going to be the top of the range or the bottom of the range? Right? For Target, doesn't seem to be much difference in the range. It's around 5.5%. All right, with a little bit of rounding. Questions? Sorry, there's a message that says, can I do this again? What do you want me to do again? The assumptions numbers? Talk about these numbers, where they come from. So these numbers are going to be off the EEO screen. So on the EEO screen, down here, forward year 2, forward year 3. Okay. EV to revenue is right here. So 0.51, 0.49. That's those first two numbers. And EV to EBIT is right here, 9.28 and 8.91. Those four numbers are these four numbers. Type them in. That's why they're yellow. Then you just divide. You divide that by that, and that will get you your perpetuity EBIT margin, which again, for Target is estimated around 5.5%. And this is coming from the actual share price of the company. It's not coming from a guess. This is what the math says it has to be to justify the current share price. Now, when we do that, made all these changes, the model now says we're at 85 and Target's at 89. Now we resolve for the G. So I go back to my G and I goal seek my G. So tools, goal seek. I want the share price to be 89.02. And I want to get there by resolving for a G that does that. And so close to 0. So at that lower margin, you don't have to have as much negative growth from the current revenue and margins to get to that share price. That's the way Target is trading, right? And we could have gotten there the way I got there originally. I did the as is last week. problem is that that's not really what the market is saying, not based on the trading values of the company. Right? This is a better representation of what the company is actually trading at. So that is my as is, which I would then build my bull, my bear, my target. Other questions, comments? This is now part of your model going forward. And the only other thing we did, the ratios tab, is to make this number, either that number or the range. If you do 2 years, you might sometimes get a range. In that range is you adjust the EBITDA to adjust this to match. That's your process. All right, well, since there's no questions, your next assignment I posted this morning, work 11, so this 11, due Monday, is on Delta Airlines, right? And the reason why I posted Delta Airlines is because this morning, from a company news standpoint, Delta announced that, number one, they are going to be fighting with Airbus about whether they have to pay tariffs on the planes that they've already ordered. And Delta's position is, we are not. And number two, Delta basically said, we're going to stop giving guidance for next quarter because we have no idea what our profits are going to be. So we're pulling our guidance. So basically, it's anybody's guess what's going to happen to air travel in the middle of this trade war. So I thought it'd be a good company to work on. Okay. So essentially, that is going to be your assignment, is to look at, for the next individual homework, you're going to do Delta. You're going to do an as is, a bull, a bear, and a target. You're going to follow the process we included in class today. And you're going to add a fifth screenshot. And the fifth screenshot is back to what we're going to call EEO2. So on the EEO screen, you'll notice that I've been jumping over an extra column because I can't get more than 4 columns onto one page. So to get this extra year, I've just gone over a column. Take a screenshot of that extra year. So take a screenshot of the first 4, EEO, screenshot of the extra year, EEO2. Submit both screenshots. You're going to be submitting 5 screenshots. That's also going to be true for your group project. Just so we're matching up all of our data. Remember, when you're dealing with the airline industry, I'll give you a hint. They're very sensitive to EIC. I think we mentioned this the first week of class. What's one of the biggest costs to an airline?
Fuel.
And what's going on with oil prices?
They're down
To what?
60.
Yeah, they're around 60, down from 70 or 80. So on the one hand, they're dealing with the tariffs and potentially less travel. But the other hand, they're benefiting from lower costs. So that's all working through the share price right now. So they do have a little bit of headwinds, but they got a tailwind. And so part of your goal and kind of sorting through this as analysts is to try and suss that out and give an opinion on what do you really think is Delta stock and what do you think it's worth. Now, if you go back to last week, I just look at the overall price. A week ago, Delta was trading month to date here. What's this price? 48. And now they're trading at 38. So they've lost, $10 a share of 48. It's 20% of their value. So was that too much? Are they a long-term buy now? Is this fair? Is this going to get worse? So it should be an interesting assignment to assess this. And you'll get some insight about the margins and the trading multiples as of today. All right, so that's Monday. That's individual. So back to Wednesday. So Wednesday, group project day. Now, what you're going to have to do for your group project is take one member of your team's model and use that model for your group project. Okay, so you can't share models for Monday, but after Monday, you're going to have to. You're just going to have to pick one of your models to do the company that you chose. And so again, you're going to be turning in a PowerPoint with all of your screenshots in it, right? So imagine you'll have Delta Airlines, if that was your group project. You have your buy, sell, hold opinion, buy, sell, or hold with a target price, whatever it is. Then you'll go through the as is. Here's, and what I would recommend, which teams have done in the past, is basically take screenshots of their assumptions and their ratios. Here are the key assumptions and ratios we did for the as is and why, and then a few bullets. Then next slide, take assumptions and screenshots for the bull or the bear, and then bullet points. Here's what we changed and why. Highlight it, make it very clear. So you got 10 minutes to walk through everything you do in a paper. You're just going to be doing it in a PowerPoint. And again, it's got to be in that PowerPoint. Plus, you got to turn in your 4 Excel models. Okay. Now, right now, I got a couple teams that had picked some companies. But if there's anybody on the call that wants to tell me which company you want, we can handle that while we're here. So right now I'm in section 201. I know 2013 wanted Chipotle and 2016 wanted Domino's. Does anybody else want to tell me a company while I happen to be on the phone? That you want to work on for next Wednesday? If you're in section 201, you're talking fast casual.
Hi, we're group 4.
Yeah. Who do you want?
Can we do Kava?
Yes, you can. So group 4 is Kava. Any other teams from section 201? Right. Well, put it this way. If you haven't sent me the name of the company, you need to send it to me soon. But here's the point. Many of you, I hope, are in the lab. Today's lab day. So you should be using it not only to get your Delta data, but I would also check the data of these companies. Because remember, an unbalanced CFI, you'd have to figure out how to balance it. So I'll give you until Friday to change the company. But if you don't tell me by Friday that you want to change, you're stuck with it. Okay. And you'll have to value that company. So let's say you do Kava and it's got a screwed up balance sheet and none of the CFIs work, you can change up until Friday. But you tell me on Saturday, too late. You're doing Kava, you're going to figure it out. And remember, if you turn in an unbalanced balance sheet, you're going to lose 10% of your semester grade. So you have to have a balanced CFI. So get the data. Take advantage of the time today in the lab when it's only for 43 students. Don't wait. This time will go by very quickly. Format for the presentation, similar as last time, 10 minutes per team. All 6 teams present during the section you're registered for. Questions? Well, seeing that there don't appear to be any additional questions, I will turn everybody loose to go to your Bloomberg terminals and get your data. Remember, TA's office hours are the next 2 days. Take advantage of that if you need help as well. Good luck.
Thank you.
Yep. 2011. Yes, you have Yum Brands.